Warren Buffett has been thinking about inflation for a very long time and has repeatedly remarked on the topic throughout his 57-year career as Berkshire Hathaway CEO. Within his annual letters and during many Berkshire shareholder meetings, he's often related inflation to a gigantic corporate tapeworm that consumes its daily diet of investment dollars regardless of the health of the organism. The less prosperous the enterprise, the greater the proportion of available sustenance claimed by the tapeworm. During the 2021 Berkshire Hathaway annual meeting, when asked about whether he's seeing inflation affect his businesses today, here's what he had to say.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices, people are raising prices to us, and it's being accepted. It's an economy, really, it's red hot. Our costs are going up. Supply chains is all screwed up, for all kinds of people. But there's more inflation going on than, quite a bit more inflation going on than people would have anticipated 6 months ago or thereabouts.
So with inflation surpassing 5%, the largest consumer price jump since September of 2008, investors are on the edge of their seats, some wondering if we could be headed for a return to the 1970s when inflation reached double digits. So why is inflation a concern for investors? Well, there's quite a few reasons, but for one, it can turn what appears to be a positive annual return into a negative one. Let's say, for example, you own a bond that pays 5% interest annually. That might sound like a great investment. You'll be all but guaranteed a safe and steady return on your money while you sit on the stock market sidelines awaiting the 12-year bull run to come to a screeching halt. However, if inflation reaches, say, 6%, then your actual purchasing power on that money, or the real return, goes to negative. It drops to negative 1% to be exact. At the end of the day, real return is what matters. And for good reason. Buffett really harps on this fact during the 1979 through 1981 annual letters to shareholders. My favorite being this descriptive quote from 1980. The average tax-paying investor is now running up a down escalator whose pace has accelerated to the point where his upward progress is nil. I think this really drives the point home. If you're not properly invested and set up for success, inflation can really feel like you're just treading water for years on end. So what are Warren Buffett's tips for beating inflation? We'll cover what he believes are the best companies to invest in, some alternative investments that also beat inflation, and which investments to avoid at all costs. Before we start, please consider hitting the like button for the YouTube algorithm. It really helps out the channel and I genuinely appreciate it. Alright, let's get into it. Warren Buffett provides two major tips for identifying a strong business during inflationary times. The first being to invest in great businesses with low capital needs. He has long advocated for owning companies that earn a high return on invested capital. This becomes even more important during inflationary times when assets like railroads, buildings, and manufacturing equipment are becoming more expensive by the day. So, the last thing a company would want to do is buy more and more expensive equipment just to maintain last year's market share. Take the SaaS industry, for example, which stands for Software as a Service. Adobe, Salesforce, and Shopify would all fall into this bucket, and due to their high return on invested capital, they would all likely do very well during inflationary times. Here's Warren elaborating on this point.
In terms of capital-intensive businesses, they're just not as good if you can find an equally good business. I mean, in terms of operations, that doesn't require capital. You really want a business, and everybody wants a business, that doesn't take any capital to speak of, and keeps growing and doesn't take more capital as it grows. Now, our utility business, our energy business requires more capital as it grows. Our railroad business, to some extent, requires more capital if it doesn't grow even. So capital-intensive businesses, by their nature, are not as good as something where people pay in advance and you don't need the capital. I mean, if you look at where the top market value is in a $30 trillion market, if you take the top 4 or 5 companies that account for 4 trillion or so of that 30 trillion, basically they don't take much capital. That's why they're worth a lot of money, because they make a lot of money and they don't require the money to any great extent in the business.
As you may already be thinking, there are two sides of the equation. When equipment or building costs rise due to inflation, that's because one company is raising prices to another. For example, Ford or Chevy may need to raise prices because they're paying more for crankshafts, pistons, and engine blocks from their suppliers. Meanwhile, those suppliers are likely raising prices because the prices of steel are on the rise from their raw material suppliers, and so on and so forth. So, Buffett's second piece of advice is to invest in companies that can raise prices during periods of high inflation. During a testimony that Warren gave to the Financial Crisis Inquiry Commission, or FCIC, after the 2008 collapse, He stated, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising prices by 10%, then you've got a terrible business." Here he is during that same FCIC meeting speaking on the pricing power of Moody's Corporation and even the SEC.
They have been diligent in terms of what I have seen at the Berkshire Hathaway level and in terms of our insurance. Now, they also have this incredible pricing power. I think they ought to be doing it at a much lower price as far as I'm concerned. And of course, I think they ought to be rating us right up there where Standard & Poor's has us, but that's another question.
And what is the source of the pricing power?
The source of the pricing power is that if you're an insurance company, as an example, but if you're any issuer of securities, people expect you to have a Standard & Poor's and Moody's rating. And it's very small, the dollars spent as a percentage of the total bond issue or whatever you may be doing, but it's required. It's like an SEC filing fee. Basically, you're not going to come to market without it. And if the SEC doubles its price for filing fees, I pay it. If they triple it, I pay it.
So, like he described the SEC, if a business can increase its prices, it has a big advantage during periods of high inflation because it can offset its own increasing costs. Just like increasing a price of an engine block you sell to Ford because the price of steel is on the rise. Buffett once gave the example of an unregulated toll bridge. He explained that it would be an ideal asset to own in an inflationary world. You've already built the bridge with pre-inflation money, meaning you've already laid out the capital costs, and could now raise prices to offset inflation. So, as Warren puts it, you build the bridge in old dollars and you don't have to keep replacing it. Let me know your thoughts on these investing tips down below in the comment section. I'd love to hear from you guys, and I always try to respond to everyone. Okay, so we get the idea. When investing in the stock market, invest in companies that don't require much capital to continue doing business, and also invest in companies that can easily raise prices without any drop-off in consumer demand. But what if we want more diversification and to invest elsewhere? Outside of the stock market, Buffett's main piece of advice for surviving inflationary times is to invest in yourself. Investing in your own talent is one of the best ways to maintain your purchasing power over time. The best nurse, engineer, or dentist in town benefits from an education paid for in old dollars, before inflation, but is able to price their services in current day dollars, post-inflation, without having to re-educate themselves. This is similar to a business that doesn't require lots of continuous capital investment just to maintain its output. Here's Buffett speaking on the importance of investing in yourself.
The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. If you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate.
So consider building out your resume by learning highly valued skills through books, online resources, or even a local college. Depending on the skill set, this can range from free to highly expensive. While copywriting and software development can largely be self-taught and low cost, there's really no getting around the 8 years of formal education to become a dentist, which is probably a good thing. Buffett's point is that if you never stop learning and become an indispensable employee, this will increase your value to an employer, providing you leverage and help you command fair share of earnings over time. His second piece of advice for alternative investments is to invest in real estate. Due to land being a limited resource, real estate will increase in price as inflation rises. Since 1972, inflation has averaged 3.9% per year, but real estate has returned 9.2% per year. This provides you with about a 5.3% real annual return, which does not outperform the stock market, but will add stability and diversification to your portfolio. Here's Buffett speaking on the topic.
The best businesses during inflation are usually the best. They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay, and you get an inflationary expansion in replacement capital without having to replace yourself. And if you got something that's useful to someone else, it tends to be priced in terms of replacement value over time. So you really get the inflationary kick.
If you don't want to purchase homes or land, a lower barrier to entry would be to simply invest in real estate investment trusts, also known as REITs. To get you started, check out Vanguard's VGSLX, which is a broad, low-fee real estate index fund that provides plenty of diversification and a 2.9% dividend at the time of this video. Okay, so we know what to do during inflation, but what should we avoid? Well, Buffett recommends avoiding 3 different asset classes. The first being traditional bonds. In his 2020 letter to Berkshire Hathaway shareholders, he wrote, "Bonds are not the place to be these days." The 10-year U.S. Treasury bond yield was 0.93% at year-end, fallen 94% from the 15.8% yield available in September 1981. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. The second asset class to avoid, Buffett says, is gold. An investment often thought to be a great inflation hedge, Warren Buffett has notoriously shunned gold. Here's Buffett comparing gold to productive assets like businesses, real estate, and farmland.
When we took over Berkshire, Berkshire was selling at $15 a share, and gold was selling at $20 an ounce. And gold is now $1,600, and Berkshire's $120,000. But you can take a broader example than that. If you buy an ounce of gold today and you hold it 100 years, you can go to it every day, and you can coo to it, and you can caress it, and you can fondle it, and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it, all kinds of things. For 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end of the 100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400, but you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time. Now, people, they like to speculate. They like to gamble. And if you can get something, particularly if you had something half plausible going on, if you had bought gold in 1942 and you say, we might lose the war and we might have to run off to some other country, and so let's put our assets in gold, you would have less than a penny for every dollar you got from owning stocks. Less than a penny. Now, if somebody calls that a store of value, I think they're delusionary.
And seeing his hesitation with non-productive assets, it's probably not a surprise that he extrapolates that same logic out to the digital version of gold, Bitcoin. This has become a very controversial opinion. Here he is explaining it.
What is it about Bitcoin that gets you guys so fired up?
Well, when you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. You look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing. If you and I buy various cryptocurrencies, they're not going to multiply. They're not going to be a bunch of rabbits sitting there in front of us. They're just going to sit there. And I got to hope next time you get more excited after I bought it from you, and then maybe I'll get more excited and buy it from you. And actually, we could sit in a house by ourselves, and we could keep running up the price between the two of us. But at the end of the time, there's one Bitcoin sitting there, and now we got to find somebody else, and they come to an end. If people think they're going to make money the next day, and worse yet, if they think somebody else that they know is going to make money and they aren't going to make money, it just draws people in.
And to wrap up on a light note and a bit of practical advice, Charlie Munger, Buffett's business partner and vice chairman of Berkshire Hathaway, recommends limiting your wants in life and not giving in to lifestyle inflation. Here's Charlie on his own take for how to best cope during high inflation periods.
One of the great defenses to being worried about inflation is not having a lot of silly needs in your life. In other words, if you haven't created a lot of artificial demand to drown in consumer goods, why, you have a considerable defense against the vicissitudes of life.
Charlie, we're selling consumer goods in the other room.
It's okay to talk that way at home, but
Doesn't do any good there.
I know the feeling.
All right, if you enjoyed this content, make sure to subscribe and hit the notification bell to be notified of future videos just like this one. To continue learning about investing, watch this video right here.